long the delay is to you or where you are in the world. Um, Thank you for your patience. We are getting started now. We're talking about banking, bank shares, bank stocks, bank equities, banking in general, just whatever you think we want to talk about related to banks. That's what we're going to be talking about. Thank you to everyone that's already left a comment. Mick, Paul, Caroline, Graham, Daniel. I can see you all. And in a moment, we're going to be joined by Nathan Bell from Intelligent Investor. I absolutely love chatting to Nathan. He's one of my favorite people, probably in the world, to chat to just about anything, because he always keeps it engaging, and he's super smart. So I can't wait to welcome him onto the show today. You may know Nathan from Intelligent Investor. He's a writer as much as an analyst, probably more an analyst, I would say. He'd probably correct me on that. But you can check out anything to do with Intelligent Investor at intelligentinvestor.com.au. Experienced investor who he's going to take us through some slides today. I'm going to kind of take a bit of a back seat. I've got my black coffee here, and I might make some animal noises like "huh" or interesting as Nathan goes through, and then hopefully we can get some time for some questions at the end. But as you know, every week Thursdays it's Rask Invest Live. There's a photo of me in my business shirt / a flannelette. Bank bubble. I don't know. I've given it that title, but we'll let Nathan explain it as he goes through. He's got a few slides for us. Warren Buffett famously said this quote: "Be fearful when others are greedy, and be greedy when others are fearful." I thought that might be relevant for today. Let's find out in just a moment. So, as I said, every Thursday you can catch us. We've got some great partners for the show, including Navexa, PocketSmith, Perla, and Superguide. Wonderful resources. They're also available in your YouTube description. If you haven't already subscribed, that's pretty easy. Just hit the thing that says subscribe and you'll get notified every time we drop a live show. And we also release at least one podcast episode on one of our various shows every single day. Our Australian Retirement Podcast has proven to be the fastest growing podcast we've ever released. And it's probably not entirely because of Drew. I credit James, but Drew's pretty good too. So general advice warning, Nathan and I are going to be talking about companies. We're going to be talking about all different types of stuff today. Now, we don't know your personal situation, your goals, your needs, your objectives, any of that sort of stuff. We might also talk about ETFs. We might talk about funds. Be sure to remind yourself that those things have product disclosure statements or PDSs and TMDs. There's one of those available, or multiple of those available, on the Intelligent Investor website. There's one available on the Rask website. We don't know your needs, goals, objectives. So that's why you need to get personalized financial advice from a financial planner before you act on this information. And at the very least, you should always read the PDS and the TMD before investing in something. I just think, like, if you're putting your money on the line, take the time to read it and understand what you're buying. So today we're going to talk about are banks in a bubble? Nate's got some great slides for us to go through. There'll be a bit of like how to analyze a bank, like the metrics you look for, that type of thing. I've asked Nathan maybe if he can just give us some like alternatives or just ways to think about what else could we do right now. We'll have a little bit of time for Q&A at the end. But Nathan Bell is the head of research at Intelligent Investor. I think he's also the head of portfolio management. I feel like that's two things in one. So maybe he's whoever's employing him is getting a good deal. So Nathan, welcome. I think this is welcome back to you, my friend. It's good to have you with us.
Thank you, mate.
Would you describe yourself in any way as a writer, by the way?
A poor one, and I try to do as little of it as I can these days. But we have, without doubt, some of the best finance writers in the country, and led by John Adders. So there's no other John Adders. So if anything happens to him, the Australian financial landscape would be really losing someone. And I'd say his articles on a Friday afternoon in our subscription business are almost worth paying a subscription for by themselves.
Oh, they are. And he's got a great book out recently, How Not to Lose $1 Million. Had an interview with him recently for the show, and he's an absolute treasure. So if you haven't already checked that out, it actually details some of the thinking behind and the learnings behind the Intelligent Investor. You can take up an Intelligent Investor subscription if you're watching this and you haven't already done so. There's a free trial available on the website, but you can also invest in the strategies, and that's where Nathan spends majority of his time. He's managing portfolios on behalf of the investors with Intelligent Investor. Now, mate, I believe you are going to share some slides for us. So I'm going to bring them up here on my end, and you can just have at it. I'm going to try and bring some energy, and if you've got some commentary in the chat, bring it forward. Nathan, mate, over to you.
I should have named this the bane of my existence. The bank bubble doesn't really cover the pain it's causing us at the moment, I tell you. I remember, I think it was about 2014, we did a presentation for, I think it was the Sydney chapter of the Australian Shareholders Association, and told everyone the salad days were over for the banks. And there was a bunch of people up the back. It just got stuck into us, saying, "No, you're kidding yourselves, and you always got to back the banks." And then it was essentially like a dead decade for the banks. No earnings growth, share prices went nowhere. And I remember, it's funny how I probably make over 1,000 decisions in a year about what stocks we hold, buy, sell across the funds and in the subscription business. But in the year that you have, is probably comes down to two decisions you made a couple of years ago, and that couldn't explain our current underperformance better. And I would never have thought, like, it's natural that a value investor always struggles when the market gets this expensive, because you're just avoiding the momentum driven stuff, waiting for it all to fall over to buy the cheap stocks, and you're all focused on cash flows and all the rest of it. I would never have imagined the banks traded at valuations like these. So I just want to be clear, I'm not out there telling anybody to sell the banks. There are actually lots of reasons why some people will never sell the banks. But there is actually a couple of interesting things in these slides that I think is unusual. And if nothing else, at least you've got some sort of expectation about what returns to expect, and what maybe some alternatives are.
I just want to double click on that. I think that's a really important point around, people holding these assets for a very long time and thinking to themselves, like, there are other implications from a portfolio management perspective, from a tax perspective, but this is just a really good critical assessment of the banks. And there's one slide in particular I'll call out in a minute. Now, I'm going to mute myself because my chickens are going nuts outside. So I'm going to throw it back to you. And if anyone has any comments or questions throughout, just bring them on, chuck them in the chat.
You sure they're not some of our investors looking at our recent performance?
I've since learned in speaking with people from Sydney, Nath, that if you have chickens outside your window, it's almost like a bit of a humble brag. So the fact that you can actually have chickens,
They think you live in Barrel.
yeah, exactly. So over to you.
So I just want to point out too another thing. All the numbers that I'm going to talk about today don't include franking credits. So I know they've been very valuable over time, and especially valuable to certain people. So you need to incorporate those into the numbers I'm going to talk about, because franking credits can be worth up to 1 to 2% a year for some people. But I'm just ignoring that for today's discussion. And the other reason why a lot of people don't want to sell the banks is because they probably own, a lot of people have owned CBA since it IPO'd at $5 a share, and they don't want to pay the tax. And after, if they were to sell CBA now, pay the tax, and then try and find something that's got to make up the difference, the alternatives aren't that necessarily that great at the moment. So I understand all that. This is really, take it or leave it. I'm not trying to convince anybody to sell their banks. This is really just a valuation exercise, and you can make up your mind what you want to do with your personal situation. So I always put quotes in my slide decks. I do them as much for myself as I do anyone else. But I just thought this one was a good one, because everyone's asking me, okay, well, when are the banks going to fall then, and what's going to make them fall, and what else is going to happen? And if they fall, won't all the market fall? And, we can maybe have a chat about that at the end of the presentation. But the short answer is I don't know. But it's just interesting how everyone thinks something that's overvalued, that it's going to fall at some point, and it might not. It just might be a lost decade where you just don't get any capital gains, and that ends up actually being a lot worse over time. But you're not really thinking of that in the current moment.
I think we might have just lost your
Yeah,
slides there, Nath. Oh, they're coming. They look like they're coming back.
is that a problem at my end?
Got them now. Perfect.
Okay, so this is the ASX overall, but because the banks are such a dominant pillar of the index, they're having the most influence. And you can imagine that part of the reason the bank stocks are actually trading so high is people are trying to escape any exposure to China, which includes our big iron ore stocks. So they're trading much lower than what they were. And a lot of the money, not all the money, but a lot of the money has just come out of the resources sector and gone into the banks, because it's not that they think they're getting a great deal with the banks. It's just that they don't want to lose money on the iron ore miners. But you can see the impact on the market generally. The way I think about the index is a quarter of it's the iron ore miners, 30, depending on which index you're looking at, 30 to 35% is the financials, which is the four banks and Macquarie. You get about 20% in A-REITs and then CSL, and that's basically most of the index. So you can see the impact they've had. So this chart goes back to 2000, which was essentially the tech boom, or just after. And we've actually never been here, at least in modern history in Australia, we've never had valuations like these before. So we're in a really unique period of time. So my question is, when did the banks become AI stocks? This chart here measures the valuations of Australian banks compared to the world banks. And you can see we've just never had anything like this before. We can talk about the absolute, or we will talk about the absolute returns from the banks shortly, but there are other wonderful banks around the world, as Australia doesn't have necessarily just the most profitable oligopoly in the world. So for them to be trading, way above the 90th percentile in history, just shows you how crazy it's gotten. I've run out of superlatives to explain this bubble. It's really amazing. But the most amazing thing about it is normally bubbles, froth on new technology or growth stocks where it's either people just trying to get rich very quickly, or it's exciting new technology or growth where it's actually quite hard to pin down what the growth might be. The difference with the banks is there actually is no growth. In fact, the profits being reported recently fell as far as 8%. So it's just so unusual where you've got falling profits and yet this incredible bubble where valuations just keep going up every day. It's again, I've run out of words to describe it, but it really is incredible. So this is the 12-month forecast dividend yield for the market as a whole. But basically this dividend is by far and away made up between the iron ore miners and the banks. And you can see that we're plumbing almost record lows, at least since 2000, to the modern era. The iron ore miners have been cutting their dividends as the iron ore price has fallen. And the banks are just yielding so much slower because even though there have been some cuts, but also some slight increases that probably even out, but it's actually just the prices have gone up so high that the current yield is so low. So it wasn't actually that long ago I was doing a webinar for our income fund saying, we're going to have a 6% income return this year, and franking credits on top of that. And here we are, it's only a year or two later, and the market's barely yielding 3%. This is just the earnings per share for the index, and you can basically, all you need to take from that is that it's falling. It's not surprising. I talked about the major sectors, and in the banks they've been falling, which we know, and the iron ore miners have been under pressure from the falling iron ore price. So there's essentially half the market, and the A-REITs have been under a bit of pressure as well through higher interest rates or vacancies in the office sector. So what's interesting is it's not just the banks that are trading at record valuations. It's companies like JB Hi-Fi, which has done extremely well as a business, but it used to trade at 10 times earnings. You could just rely on that every year, and now it's trading at 20 plus times earnings. Now maybe it deserves the higher valuation. It was just the market undervaluing it for all those years. But the question I've got just more generally is, should all these cyclical businesses where there's no growth or little growth be trading at record valuations while the expectations for earnings are falling? And you can imagine what happens if, I don't think a lot of people understand this, but lower interest rates are actually bad for banks because it crunches the profit margins, or what we call in jargon the net interest margins, which is just the difference between the rate that you lend at and the rate that you borrow at. So low interest rates, like, they try to spur on credit growth, but it's the margins that matter for the banks, and they've been crushed over the last decade. They're less than half what they used to be. I think if you go back probably 10, 12 years ago, they were about 4.5%, and these days they're under 2%. And that's not going to change. They're not going back. So that's a permanent change in the industry. So this chart here isn't actually of the bank's concentration of the index. It's actually the concentration of the top 10% of stocks by size versus the entire US stock market. And you can see that outside the tech boom, we've never really been so concentrated in the US market. And I'm sure everybody's heard about the Magnificent Seven. But we've actually got our own similar situation where we've basically got the Magnificent Five, if you want to include Macquarie. And depending on which index you look at, the financials are now about a third of the index. So that augurs very poorly, because you generally see what happens when one particular industry gets to those sort of peaks. The following decade is usually atrocious. And my guess is, depending on what you think is the right valuation for the banks, again, you've got to take a few different factors into consideration. But I would say conservatively, there's at least the ASX is artificially inflated by at least 10%. But if you actually go back to what I think is actually fair value, so that's not cheap. This is just the banks going back to fair value, not being a little bit more expensive than what like they usually are, then there's potentially 15% there. You've got to remember too, Commonwealth Bank, which we'll talk about in a moment, is by far and away the most expensive out of all of the 4 banks. But the other 3 banks' total market values are basically almost the same as CBA's. So if you want to talk about the index, essentially CBA is half of it. So I believe CBA is now the developed world's most expensive bank ever. So whether you look at a price to earnings ratio, which I think clocked up to 27 times the other day, which is just extraordinary, given you can buy Google for about 21 times with a absolute humongous amount of cash sitting. In fact, I'm not sure, but the cash might actually be as big on the balance sheet as what CBA's market cap is. But this extraordinary business is trading. So CBA is actually trading more expensive, not only than Google by a long way, but I think the other day, for the first time that I've seen, CBA has a higher price to earnings multiple than CSL. So just extraordinary. But whether you use a price to earnings ratio to value the banks, or whether you use book value and use some sort of value based on return on equity, which I'm going to do the exercise for you shortly, it just doesn't matter. It's just in the stratosphere. And again, it's incredible. So here's just another way to chart the valuations of Australia's banks with the rest of the world, or at least the rest of the developed world, where comparisons are easy to make. We're not comparing it to HDFC in India, for example, which is growing very quickly, or something like that. These are just mature banks, the best sort of similar to England and the US. And you can see our banks are just, whether you value them on a price to book ratio, on a forward price to earnings, they're just absolutely on their own planet. So this is a little exercise which I'll explain slowly, because this is really where the rubber hits the road. So what I've done is I've compared Commonwealth Bank to 3 other similar banks in other parts of the world. So there's Lloyds there, which is basically the CBA of the UK, and ING, which is a very good European bank. I'm sure most people are familiar with ING in Australia with their online bank. And the bottom one is JP Morgan, which is the big US bank, which is widely regarded as the best bank in the world. So they're not all exactly the same. So you have a lot more mortgages compared to, say, JP Morgan, which is much more diversified. So depending on what you think is the better business, I'd definitely go for the more diversified JP Morgan personally. But other people who believe house prices just go up in Australia and we've got crazy immigration numbers and all the rest of it, then maybe you're happy with the ever increasing exposure to mortgages. You might think that's safer. And also I think Australian banks still come with a virtual government guarantee that everyone will be kept well or healthy if we ever have a crisis. But anyway, what I've done there is, on the left-hand side, you can see the return on equity, and that's really the key measure of profitability for a bank. So for people who maybe aren't familiar with that, or just started their investing journey, that's essentially, it's just the calculation is very simple. It's just taking the profit and dividing it by net assets, or shareholders' equity, or book value, whatever you want to call it. They're all the same thing. But also, what it's telling you is, if you bought the business today, if you bought it in its entirety, and you paid book value, that's the return you'd get every year. Now, the thing is that these stocks are not trading at book value. In fact, for CBA, it's trading at 3.6 times book value. So you don't get 13.6%. You essentially get the 13.6% divided by the 3.6, which is about 3 or 4% at the current price. So the price to earnings ratio, when I did this a week ago, was 26, and the current yield for CBA is 3%, fully franked. Now you compare that to Lloyd's, and its return on equity is a little bit behind CBA's, but its price to book value is a quarter. Its price to earnings ratio is less than a third, and the yield is 5.2%. You have a look at ING, which has got an equivalent return on equity, so exactly the same profitability, but it's only trading at 0.9 times, so not even 1 times book value. Price to earnings ratio of 7, so less than a third, almost a quarter, and you get a 7.5% dividend yield. And ING is an excellent bank. It's one I used to cover in my old job. And then you've got JP Morgan. Now, US banks and US companies aren't big dividend payers. They tend to buy back shares over paying dividends, but nonetheless, it's got a far superior return on equity. So a world-leading return on equity of 16.2%. Deservedly, its price to book value is 2.1, and it trades at half the price to earnings ratio as CBA, but and the yield's not even that much less. But obviously they're not like for like. You've got to take currency risk to buy these stocks and those sort of things. But it just shows, all I'm really trying to say here is the CBA is basically on its own planet at the moment as far as valuations are concerned. This is actually one of my favourite slides. I think it's Shaw and Partners printed this, and I think they might have borrowed it off UBS. But this shows you who's actually been buying the banks and who's been selling. And normally when you get to the later stages of a bubble, it's what they call the dumb money. And the dumb money they're usually referring to is individuals that are coming to the market who have no experience and are just trying to get rich quick. And they're usually not, investing their life savings. They're not life investors or anything anyway. But they're really what drives those really ebullient prices towards the end. And actually what we're seeing is the opposite here. We're actually seeing that Australians are actually selling their bank shares and really cashing in on these crazy valuations. So that's a real change, and I think that's fantastic from my point of view, because it just means people are paying attention. And I imagine a lot more Australians are probably looking elsewhere for the value these days. They appreciate the quality of the growth stocks these days, which are just so dominant, and probably a few more people buying overseas stocks than what they ever used to be. But if you move on away from the orange line and down to the other two, the question is, who on earth is paying these outrageous prices for these stocks, and who's locking in these 4% or 5% annual returns for the next decade at best? That's assuming everything goes well and nothing goes wrong. And it's probably not surprising to anyone. It's the big super funds. So that's the domestic institutions. So that's the black line at the bottom. They're basically taking in 10% of our wages every week or every month, and there's really not a lot of places they can invest that money. The two biggest sectors in the ASX are the banks and the resources sector, and because nobody wants any exposure to China at the moment, it's just getting funneled into banks that they're happy to take their 4 or 5% returns. So even if you don't own bank stocks directly, if you have industry super funds, for example, or some other big fund manager that is essentially just an index investor, then you can't expect to be getting 10% annual returns for the next decade when a third of your money is probably invested in the banks at the current prices. And then there's another one, it's the grey one. You can see just how much it's increased over since the GFC. Australia is actually, ironically, seen across Asia as a really stable market. So a lot of people who are trying to escape China exposure at the moment are just parking their money temporarily in Australia, and if they put it in the Australian banks and they pick up a bit of yield, they might even pick up a bit of a currency gain potentially, and so they're happy hiding out there. So to me, what I think that is, I would think of that as the hot money, and again, it just shows you it's not really focused on valuations. It's just a place to hide more than anything. But of course, what you've got going right across the market at the moment is the incredible impact of ETFs and passive investing now, where the momentum is just driving a lot of the prices, not just in bank stocks, but in growth stocks in particular. And so that's something fairly new to the market. But I think passive investing now far outweighs the amount of money being managed actively, like we do, for example. And you only have to look at a couple of our funds to see what it's done over the last couple of years. If you haven't been in the right stocks, it's just torched your performance. So it's been really painful for us not being in the banks, but I thought they were expensive 2 years ago, and nothing seems like it's going to stop them at the moment.
Hey, Nath, can I ask a question here? This is something that I think about a lot. I feel like if you got like Aussie Super, Host Plus, Rest, or Retirement Trust, like all those gigantic fund managers, like even probably like the Future Fund, and they're just like, what are we going to do with this money? Australia just saved 10% of its income last month. We need to do something with it. So they just shovel it straight into, like, admittedly, they'll put some overseas and some here and whatever. Does that just mean that like what we have to get used to is rising valuations over time?
Yeah, that's really interesting, right? Because I think if you read your history books, there have always been these periods where someone comes in and it basically says that, and just says, for whatever reason, we've reached the permanent plateau of higher prices. And I think that's what you need to think about with the banks, is it might not be the next decade might not be a big fall, a 50% fall or anything like that. It might just be 10 years where the share prices don't go anywhere. But I do think personally, I think any time, I think as we were talking off air before, this is the third or fourth time in my career where we've gone through these bubbly periods. And every time someone says, whether it's tech stocks or banks this time, or growth stocks, or go back to the Nifty 50 area when it was just the great growth stocks in the US, for people who can remember those. Just every period has its amazing bunch of stocks that just go to these crazy valuations. But the stock market has a 100% strike rate of deflating or popping bubbles. It's really just a matter of the timing. So I don't subscribe to that. But I do think what has changed across markets, aside from the impact of passive investing, is that it's far more competitive than it's ever been. There's far more people looking at stocks than there's ever been. And I think because there's so much money chasing so few ideas, because there are only so many great businesses, you can actually see those premiums in Australia. And a classic example would be Reece, the plumbing business, which trades on nearly 40 times earnings, or was, which is just absolutely mental. It's a plumbing business, not an AI business. And yet there's a similar company in the US that traded for half that up until recently, called Ferguson. You can do the same thing with Rightmove in the UK, which trades at about 20 or 21 times earnings. And REA Group, which is basically the same business, is trading at 50 times. Now, maybe REA is growing faster, and it deserves that premium, but does it deserve 30 times PE more, 30 times more PE points? Particularly with the management that seem to be getting bored with their money machine and want to do stupid things by expanding overseas, where they've failed over and over again. So it's not just valuations too. I think people underestimate the impact that CEOs and boards have on companies. REA Group, to me, is probably the best company on the ASX. It's certainly one of the top 5. It's perfect as it is. Like, you cannot make a better business. And yet here's management trying to go overseas and make a big acquisition after they've failed miserably in Italy and Indonesia and everywhere else. So that's why you need a diversified portfolio. But in terms of permanent plateau for these higher bank share prices, well, I guess my answer would be 2 years ago, they weren't trading at anything like these prices. So what's changed in 2 years? Those industry funds have still been around, and I think the only difference really is that the money wants to get away from China.
That's a good point, mate. Thanks. That's actually a really, practical point. Thank you.
If you were to ask me, maybe I'm jumping ahead a little bit here, but I didn't actually have a slide for it. But people ask me, like, what's going to knock it down? And the thing is, you never know. And it's the same with just general valuations. But you don't need to know. All you need to know is it's risky, and at best, your returns are going to be low. And as long as you know that, then at least you can make the right decision for yourself. What makes sense to you is holding CBA and not paying any tax and getting a 3% dividend yield because you own one of the best banks in the world. Is that enough for you, and getting your franking credits? And if it is, then that's great. You don't even have to worry about any of this stuff. But for people who are actually trying to get their money to compound as fast as they can over time without taking big risks, then it's pretty hard to make a case for the banks at these prices. So you'll want to be weighing up your alternatives. But we're all different. Some people have oodles of patience. Some people like buying small caps, others don't. Most people listening today wouldn't own too many small caps, I wouldn't have thought. And of course, if you sell something, people want to immediately replace it with something similar, and the market doesn't always allow you to do that. I thought this was really interesting. So this is the retail, so there's just individual investors in Australia. This is how much of the individual banks they own. And you can see the big rise in NAB after, not McGowan, I've forgotten his name now, but the ex-New Zealand CEO came in and fixed it all up after he had a terrible time of things trying to fix one of the banks, RBS Scotland in the UK, which didn't really turn around in the end. It was just too hard, but he did a wonderful job at NAB. And he's left recently, but you can see the increased profitability there, and so obviously people were buying that and got a really nice ride. So now, NAB's actually not that much less expensive than CBA, but it's no surprise people have been buying that. But you can see, it's just been gradually down and down, and you can see that quite the dip here in the last bit actually that affects all the banks. So for the first time since 2011, which is 13 years, CBA's retail ownership has fallen below 50%. So we are in a unique period, and a lot of things are happening that haven't happened before, haven't happened for a long time. I'll just read this straight off the slide. This comes from Macquarie. So people again asking, who's actually buying the banks. So Macquarie notes domestic institutions were significant net buyers of most banks in the June quarter, which I obviously assume has continued in the September quarter and continues to happen to today. Overseas domiciled institutions were also net buyers. Interestingly, Macquarie also points out that the index funds were responsible for much of the flow. And I think that last point there is important because a lot of people are saying it's not ETFs and not passive investing that's driving it. But Macquarie is saying that's not the case. That it is actually them buying, and that makes perfect sense because essentially they've got to fight each other. As one stock goes up and the weightings change in the passive fund, essentially has to re-weight. So it's just got to buy more of that stock. So what's interesting to me is actually if this just does turn at some point. So let's say, let's say there was a recession, interest rates got cut down to 2 or 3%, which would smash the profit margins of the banks. What happens when all this passive ETF buying actually goes into reverse? And I think that's going to be really interesting. The only, as far as I'm aware, the only time this really happened before was for people that might remember Black Monday in Australia, where portfolio insurance, which was really a new algorithm in computers that said, if stocks fall a certain amount, then keep selling. That's the first really computerized event, I think, of the modern era. And
Was
that's
that,
why.
Nath? Was that when share prices fell at 27% in a day or something like that?
Correct. I think it was Friday overseas when everything fell, and then the Aussie market, everyone woke up at 10 a.m. and it was down 27% when they woke up, or when they turned. I don't know, they turned it on monitors or what they were doing back then, but but crazy, right? So I think what's going to happen in the future, and we saw this with the COVID bear market, was because so much of the trading in markets today is dominated by algorithms or computers. The cycles are like the pricing changes are going to happen much faster. That COVID bear market only lasted about 3 days, and it just fell really fast. And then all of a sudden, everyone went, "Oh, actually, it's probably not going to be that bad." And then stocks went up. So if you didn't buy the stocks in those first 2 or 3 days, or it was really only 2 days, then you missed out on the bargains. So I think it's going to be really interesting if the banks do turn down at some point, or maybe there's more confidence around China and the money starts washing back towards the resources stocks. It'll be interesting to see just how quickly these stocks fall. So an ominous warning: CBA is now 10% of the index by itself. CSL did this 5 years ago, and its share price is still lower than there. And BHP, very similar situation when it hit 10% of the index a number of years ago. I thought this was quite funny, this chart, because Macquarie is showing here which stocks are being bought by local and offshore investors. And you can see the offshore investors that seem to have favoured ANZ because it's the cheapest. And that's always been the problem buying ANZ. It's always the cheapest, but it's cheap for a reason. And after that, they bought CBA and they haven't bought much of the other two. Whereas domestic institutions, they know, the local knowledge says, we don't own ANZ. We know it's a inferior business compared to the other banks.
It's a basket case.
So we're just going to buy in terms of quality. And you see it's the quality CBA, NAB, and then Westpac. So it's pretty funny. The other thing, just as a bit of a quick story, but I remember that there's often US investors at some point come to Australia and buy some stocks. And we have a predilection to support companies when they hand the hat around looking for money. So whenever there's a capital raise, we just sort of take it in our stride and seem to participate. Whereas the Americans absolutely hate that they hate the dilution, and they always think you can get away with much higher gearing ratios if the business just hangs in there and the banks give them a bit of room to maneuver. So that's just one of those real cultural differences, and it's funny seeing the lack of knowledge there really playing out in terms of ANZ and the rest of the banks.
I'll just jump in here. Graham said, I used to work at ANZ. It is cheap for a reason. But his previous comment is he also avoids the big retail funds and super funds because they just do the same thing. And he only holds Macquarie. So
and I think that's like, in all honesty, I've talk about the performance of our funds later, but we've had a slight tilt to some esoteric resources stocks, and we haven't owned the banks, and I'd say that's probably cost us 20% alone in the last 2 years of performance. And as we were talking about off air, like we were almost 2 years to the day we were flying. It was when our coal stocks peaked, and then it's been really tough going in the 2 years since. And so 20% returns just basically from essentially one decision. It's been really painful. And I think if I had my time over again, particularly our income fund, I would just park a CBA part and a Macquarie part and just leave them there. Which is actually what I've done with some other stocks like BHP. We're certainly not market weight BHP, but it just helps smooth things, and it helps the dividend and the yield of the fund. And I'd much rather own Macquarie for the next 10, 20, forever than any of the banks.
Yeah, agreed.
So my question here is CBA the new Woolworths? So Woolworths share price at the moment is below where it was basically when I joined Intelligent Investor back in 2006. I was actually covering Woolworths back then. I think it might have been $24, and back then it was just considered just an incredible operation. It was almost like the real estate, the REA business of the day, because you had everything. You had all this growth, supreme business, amazing financial characteristics, low debt, massive ROE, lots of growth in front of it, dividends, huge capital growth. It just had the lot. And then what happened? Here we are, 18 years later, and the share price is lower. And it's interesting. Another analogy is I remember probably up until 2016 or 17 that for the previous 16, 17 years, so basically since the tech wreck, every value investor used Microsoft as an example of what happens when you overpay for a great business. There's there's all these quotes about value investing and how important value is, and paying the right price and all that sort of stuff. And Microsoft since then, I think it's gone up 10-fold or 12-fold or something. And so no one talks about that anymore. But Woolworths is just another case where you overpay for these stocks, and you might not get a huge fall, but in saying that, there's a fall there from $36, I think, just before the GFC, down to what looks about 20, 23, $22 in 2017. So that's a 50% fall. So you do have these big falls. But you look, what do we say, 18 years later, and all you've got is a dividend yield, which is, I'm not sure that peak, but probably average 3% if you're lucky. That's a long time. You don't want to be investing in the stock market for 3% returns, even if there are franking credits. That's certainly not enough to, particularly when there are far better stocks. I mean, imagine what your returns are if you bought REA Group back then, or which I think was $4.30 or something ridiculous during the GFC, and you've made, what's it, 75 times your money or something. There's no need to sit in these stocks. So here's my second question: is new CBA the old CBA? And you can see if you go back to 2009, if you go back to just before the GFC, the stock price was over $60. And if you look forward 10 years, you had very few capital gains. You also had the big fall, but that was mainly the GFC. But you had very minor capital gains. And you just got your 3 or 4, I don't know what it was, maybe average 4 to 5% dividend yield, which is certainly not the worst case. But again, you think about all the other great stocks you could have owned during that period that were obviously great stocks back then. And again, it's just the valuation. It's not like CBA has really done anything wrong. It's been pretty much the perfect stock. It's survived the GFC, and it's grown earnings. I think it's grown earnings 50% through that period. So not lightning quick, obviously. You've got to divide that 50% over 10 years, but at least you had some growth, and it dominates the Australian market. So it's done everything right, just like Microsoft did between 2000 and 2016. But if the price is too high, you just don't make any money. So this I thought was really important, because you could say, okay, I'm going to own CBA just like it was 2007. I know I'm not going to get much, if any, capital growth. I'm prepared to put up with any falls in the share price along the way, but I'll bank my 3% dividend. I'll get my franking credits, and I'm happy with that. But I'll just point out a few differences between 2007 and 2024 is one, the banks they've never been this expensive before. They're way more expensive. Second is, as I just described, the earnings per share increased 50% over that essentially lost decade for Commonwealth Bank. At the moment, they're not expected to grow at all, or maybe 1% a year. So just completely different situation. As I said, margins earlier, I said margins are half what they used to be, and they're not going back. You've got more intense competition than ever. That's why Macquarie's eating their lunch. And we're also moving to a more online world now. And we're in a world now where I think 3/4 of loans actually come from brokers. So it makes selling mortgages for the banks far less profitable than they used to be. So you've got all these things that are actually much different to 17 years ago, and none of them bode well for the banks. And they should actually be all pointing to lower valuations, not higher. So again, it's just really strange, the technical reasons, if we want to call them that, for what's actually supporting the valuation today. It's got nothing to do with valuations. So I did some maths for you. So I worked out, so this is just based on return on equity, and I worked out what the share prices would need to fall by for you to get a 10% return. So 10% is what the Australian share market has delivered over the last 100 years, although the last 20 years has been more like 9%. And that's actually not surprising because most of the return comes from the iron ore miners and the banks anyway. So it's slightly circular. Again, I haven't included franking credits, which are 1 to 2% of value for a lot of people. So they don't necessarily need it to go back to a 10% return. And you can make arguments that, CBA doesn't need to offer a 10% return. It only needs to offer 6 or 7%, and then you'll get your franking credits and get a 9% return, and that would be fine for a return from a great business. But whatever you pick, I think the maths is pretty clear. But obviously, as an active fund manager, we need to outperform. So we need to be outperforming the index. So we need that 10%. But so based on return on equity and book value, CBA's share price would need to fall 62%. And I think the share price has actually gone up a little bit since I did these numbers last week. So NAB would need to fall 42%, Westpac would need to fall 40%, and ANZ would need to fall 30%. And you can actually do that very simply. If you don't understand return on equity and book values, and that's fine, you can actually do it much more simply and say, well, CBA is offering a 3% dividend yield, and there's next to no growth. So how much would the share price need to fall to get to a 10% return just from the dividend yield, or maybe with the 1% growth? And it would need to fall by 2/3. So whichever way you slice and dice it, it's a pretty incredible period we're living through as far as bank valuations are concerned. So this is just, again, I'm not telling everyone to dump their bank stocks and buy iron ore miners, because we're actually underweight iron ore miners, and we always are. And the iron ore miners are probably going to face their own problems over the next few years, although the iron ore share price is already reflecting a lot of that. But you can see in that chart, it just shows you, if you're just using some of these relationships as a base to see what's happening, and you should believe in reversion to the mean, which is a very powerful financial thing to understand. Basically just things going back to the average over the long term. Then I think this is I don't know, 57.5% was a record variance in the valuations between, or the performance gap between the banks and resources companies. But I believe this week or last week it jumped to 67%, and I believe that is a record. So there's never been such a monumental gap between the performance of resources stocks and banks. And as I said earlier, we've tilted towards the resources in our income fund. Our income fund doesn't normally have a lot of resources stocks, but we've certainly got a tilt towards that and don't own the banks. And you can see the gap there. And basically that's what it's done to our fund over the last 2 years. And this just shows you the absolute valuations for the banks and the resources stocks. And you can see the banks, again, they're on their own planet at the moment, just way beyond anywhere we've been before. And the resources stocks are slightly under the long-term average. So again, I'm not telling anyone to go and buy iron ore miners and sell their bank stocks, but it's just, if you're looking for where valuations are going to be in the future and what relationships tend to hold over time, obviously the banks one is a bit scary. So I really like this this quote here, because I think it sums up a lot what happens in the Australian market. And we've got this, they talk about US exceptionalism, but we have a bit of an Australian exceptionalism as well sometimes for some of our businesses and some of our stocks. And I just really like this quote because it really sums up what happens in Australia. And this is the reason why fund managers tend to watch what's going on in the US as much as what they do in Australia. You might do your Australian stock picking, but it's the trends that are happening, in the US market that end up jumping onto our shores. So this is trying to explain why the valuations on Australian stocks got so high, even though we don't have as many anywhere near as many growth stocks as what the US has. And it says valuation multiples on Australian stocks are most influenced by shifts in the multiple on US stocks. So put simply, when valuations on US equities expand, so too do Aussie stocks. So that's really not a good basis for valuation and for buying stocks, just because there's a lot of air in the valuations because the US stock market's just on an absolute tear at the moment. There's just a few things about our funds which we can talk about, or people can look up for themselves. But I think the story with the banks is pretty obvious, but what you want to do about it, I think just comes down onto what sort of returns you're expecting, how valuable the franking credits are, what's your stomach like to suffer any big falls, because the banks were expensive a year ago or 18 months ago before they had this run. So even if they go back to there, that's probably a 40% fall, I think, in the banks together. But that actually doesn't take them back to being cheap. That just takes them back to offering about a 7.5% return, which is still 1.5% below what the market's delivered over the long term. So not even back at the average market return, and then not even cheap. So you think at some stage, valuations always have a gravity to them. Gravity always has its wheel eventually. So maybe now we can talk about some more fun stuff.
Oh, there we go. I was on mute. I was going to ask you something a bit more fun. This has been riveting. Don't get me wrong. I love it. Absolutely love this stuff. But in terms of something that, like, where do you look at companies every single day, you and the team, where are you seeing value? Like, is there particular sectors, like you said, you're underweight iron ore stocks, which seems fair enough to me. But is like what parts of the market are you guys overweight somewhere else, or
Yeah, so it's really individual stocks at the moment, because the market itself is actually really expensive at the moment. Anything that's popular or quality or whatever, that stuff's just trading at nosebleed valuations. So you've got to have the stomach for buying what's not in favour at the moment. So most of these ideas I'm going to talk about come with their own fleas, and so people don't see them as they don't want to sell what's working and what they're comfortable with to buy these sort of stocks. But it really does explain the performance of our funds over the last couple of years. I think we did between 19 and 22, we outperformed by over 8% a year for 4 years. So it was quite incredible. And that was in an income fund as well. We've basically given all that back in the last 2 years because of all this madness and just been on the wrong side of it. But if I was to highlight a few individual stocks that are in our portfolios, most people aren't going to want to buy coal stocks, but New Hope Coal, I think at the moment, is paying an 8.5% fully franked yield, and it's expanding its Bengalla mine, which will increase earnings over time. And coal prices aren't at their highs at all. So if coal prices go back up at some point, then that's going to be gravy. But you're basically getting, with franking credits, you're getting an over 10% return just from the dividend from New Hope, and some really good managers there. So to us, that's interesting, being one of our bigger positions, particularly in the income fund. On the smaller stuff, MA Financial is one, used to be called Moelis. It's expected to grow earnings 50% over the next 2 years. So if it can do 45 cents in earnings per share in 2026, it has a calendar year end, not a financial year end like most companies. If that was on 20 times, then you've got a $9 stock. If it traded on 27 times, like CBA, which you think it would do, given CBA's got no growth and MA Financial is hopefully going to grow its earnings per share 50% in 2 years, then you might be looking at a $12 stock, and it trades at about $6.20 this morning. I keep asking myself what I've got wrong with this particular stock, because it just seems so cheap compared to everything else. Again, it's much riskier than CBA. I'm not trying to compare the two, but just in a market that's looking for growth, I think part of it is small caps are still making a comeback. They've been absolutely slaughtered in recent years, and there are some that have made huge comebacks, like Life 360 is a bit of a darling at the moment. Zip, I think that's up tenfold after it almost looked like it was going to go broke. So it's not like all small cap stocks are not performing well, but this is one that feels like it's been left behind a little bit. Another one is Eagers Automotive. This is a company that hasn't missed a dividend since it listed, I think, in the 50s. I think it was one of the ASX's first listed stocks. It's trading on around a 7% fully franked dividend yield at the moment. and it'll grow steadily over time as well. It's another one we like. So there are some high yielding stocks. They're not banks and they might not be familiar names, but there are pockets of the market. If you look at anyone doing microcaps at the moment, not that we own them, but then numbers have been absolutely destroyed in the last 3 years. So if you were to take the 2000 to 2006 period, what actually happened was the large stocks produced basically a 1% or 0% return over the next 6 years. And the small cap value part of the US market compounded at over 16% a year. So I don't know if that's the period we're going into, like rather than a GFC or a COVID big crash. Maybe that's the sort of period where nothing really goes wrong, but you get a sort of reversion to the mean in the stocks that haven't performed well in the last couple of years, and the stuff that's trading at these nosebleed valuations just reaches the limit, and they just sit there for the next 5 or 6 years as they wait for their earnings to grow into the valuations.
There was a comment from earlier on, which I might just pay some lip service to, from G Funkster, which was at the beginning of the show, which was just about like, what would you do? Just keep shoveling money into index funds and that sort of stuff. And I can answer that from my perspective. Is I think it's about just being aware of what Nathan's talking about and being strategic. It's not all or nothing. It's blending. How you blend a portfolio together is really important. Like if you invest with Nathan here, based on what he said today, that he's not going to give you all CBA and all banks and all iron ore miners like an index fund is going to be tilted towards. So you blend them together. I think there's a lot of parochial people, Nathan, when it comes to thinking about allocating their portfolio. They're like, well, I'm an index fund investor, I'm a growth investor, I'm a this investor. You don't need to be. You can have a bit of everything and you can blend them together. You could take your dividends from CBA and put them into something else. That's perfectly reasonable thing to do, in my opinion.
Yeah, and I think Shaw and Partners have a little model that I see. They're a broker once a month, and their estimated return on the index at the moment, I think, was 2.9%, where the yield was actually higher at 3.1 or 3.2, and they're actually expecting a slight capital loss. So they come up with that model, essentially just estimating where valuations have been over time. So if you do buy the index fund, which I actually do think makes sense for most people, and it's by far and away the least stressful way to invest over a long period of time, just understand that the actual return you're going to get from here might only be 3%, and that's everything going well.
Yeah.
So if you want more than that, then you've got to look elsewhere. And again, I'm not trying to pump up our funds necessarily here, but we had a period, as I just described, where we came out of that COVID bear market and we absolutely nailed it across our funds, all of them. And then the same thing happens for value investors every time. Is you buy the cheap stuff, you do really well for 3 or 4 years, then stocks start getting expensive and you start to fall back, and then the market goes into the crazy period, which I'd argue we're in now, or at least for two sectors of the market, which is the tech and the banks, which make up at least the banks make up a fairly big chunk of the index. And then all of a sudden, for 2 or 3 years, our returns are terrible. And then you go through the cycle again where the banks and all the expensive stuff comes back down, and we've got the cheap stuff and the value stuff does well, and you settle on your path for the next 3 or 4 years. So whether you buy, I think my point is just to understand what returns and risks are involved with whatever you invest in, but also different funds perform well in different scenarios. And the index funds have had the absolute best run you could have ever imagined since the GFC, right? We've had this incredible concentration where 7 stocks in the US have driven the market. I think they actually account for basically all the returns of the last 3 or 4 years or something crazy like that. You got the banks, which are essentially the only thing driving the Aussie market at the moment. The tech stocks don't tend to be big parts of the index, but obviously they're helping. And but if you're going to do something different, it can be really painful. Like you've got to have the stomach for it, and that's why I feel lucky that we've got investors that stick with us through these periods. Although just the volatility, you don't get a lot of choice over the volatility in markets, and when you perform and when you don't. But I am actually wondering a little bit whether we can be a little bit less different from the index sometimes. But I remember sitting there. But the thing is, you don't have those runs of doing, outperforming by nearly 40% in 4 years if you're just doing, what everyone else is doing. Basically, this presentation actually come from an internal presentation I did for our investment committee. It actually wasn't meant to see the light of day. And I said, like, the 37% or whatever we outperformed by over those 4 years, if we had have had a market weighting in the banks, we might be sitting here in 2024 going, "Oh, it's great. We haven't, we're not underperformed by too much. We own the banks. That's been great." But the thing is, we would never have outperformed by 37% in 4
Mm.
years if we'd owned the banks. We would have been lucky to have outperformed by 15%, and no one would have wanted that. But unfortunately, the price to pay for that is the underperformance we've gone through for the last 2 years. So, obviously, I really hope we're at the end of the elastic band and our returns are going to snap back fairly soon. But you don't get a choice in these timings. So it's
No.
as I said to you off air before, just a value investor by definition means you're never going to enjoy a bubble, but it was just nice to enjoy one for a change. But I'm really hating this one.
Well, Nath, you guys have got heaps of literature on the Intelligent Investor website. There is a link for anyone watching this that isn't already a member or even trialing. Jump into the YouTube description field. There's a link there. You can click on that, take you to the page. You can learn more about the different funds. And I think I really appreciate you coming on here, being so balanced in the approach. A lot of people come out swinging. They say, sell the banks, get out of property, all this stuff, and then leave people with they feel bad and they have no solution. And so you've come and you've said, this is something to be mindful of. Here's how you can think about things. Here's the math. I've done it for you. And here's some ways to think about maybe blending or different ways to structure a portfolio based on someone's own risk and situation. So I really do appreciate it, mate. And obviously you're a wealth of knowledge. So I hope you enjoy the wonderful rain in Sydney today. And we can let you get back to that, mate. But as always, it's a huge pleasure.
I appreciate it, mate. Look forward to catching up soon.
Cheers, Nathan. So that was Nathan Bell. As you can see, absolute wonder. It's easy to see why thousands and thousands of people sign up to Intelligent Investor Research and become members for many of them a decade or more. And I'll just share the screen once again before in case you missed it. It's right here. Intelligent Investor website. You can go on, you can look at the portfolio top 10 holdings. There you go. Just from a little while ago. You can head to the actual homepage and you can take out a trial. I didn't make anything from you doing that, so just so you know. But I think Nate presented wonderfully today. And if you want to learn more, like there's New Hope, there we go, right there. So go and consume that literature and the research. We'll be back next Thursday. Don't forget. We'll be back next Thursday here on YouTube every Thursday at midday for Rask Invest Live. You can enroll in a free course. You can subscribe, listen to a podcast, do whatever you want. You can just go and eat an orange like I am in a moment and enjoy more Intelligent Investor or Rask podcasts. But that was wonderful. Thank you to everyone that asked questions. Frank, G. Funkster, Michael, Paul, Adrian, everyone, Irene, Graham. Wonderful to see you in the chat today. Hope to see you in person soon. But that's it for today. So bye for now. I'll catch you same place next week, Thursday at midday. You know where to be.